Hello, we're going to talk about fund analysis and how to do your own timing if you have to, in case I'm not around. And you say, now I'm sunk because I was doing something really complicated and nobody's going to do it for me and I'm going to lose all my money. No, you can do it your own if you have to. I'll show you how to do that. We have various funds in this 401k, and I've did a quick analysis and plotted them out on risk versus return. And then I've put in a straight line from 0 means we never did anything but just let our money accumulate. And that's not a bad plan, okay? If your company is matching some of the money you put into a 401k, you've got a zero risk and some return you're going to get based on what the company gives you. So don't ever worry when your money is sitting there in cash that it's not gaining anything. You're generally gaining contributions from the company that match your contributions in your 401k. All right. So we look at all of these and I look at the risk return, and the problem is that, and this is not an untypical 401k plan that this particular person has, there just isn't any good long-term bond funds. And a short-term bond fund acts like cash. Cash is 0. If you draw a line from 0 all the way up to the S&P 500, almost no combinations were better than the S&P 500. In the old days, if you had a long-term bond fund sitting out here, you could mix some of the long-term bonds with any fund that was close to the S&P, and the combination would give you a curve with reduced risk till you could come out and maybe make 9% a year with only 7% risk if you had the right long-term bond fund. But most funds, 401k plans now don't have that. You can't do that. It all disintegrates into simply put all your money in the highest gainer that there is. Except you see how this one tails off from, it's farther away from the line than this is. And when you go on Morningstar and look up the information on this one, and it's chewing up a lot of its money that it makes with a lot of paying off advisors for their contributions, and they're not contributing very much because they're riskier than the S&P 500. So why pay them a lot of money when this was free? Unfortunately, this particular fund, this 401k, doesn't have a simple like Vanguard 500 S&P. If it did, that would beat everything else in it. You would just do that. At any rate, you would go to OIEJX in this particular situation, doing the same analysis on some other 401ks, and it turns out there's a Vanguard fund that is the number one you put your money in, and basically you're left with timing it. You either want to be cash if you think the market's crashing, or you want to be 100% on the one that's closest to the S&P 500, or if you're really lucky, it'd be close to the NASDAQ 100. You would make the most money, but you do have to time it. Here's another way to look at the same data. We have the SPY, that's the S&P 500. It made 99%, light blue line right there. Okay. OIEJX comes in just under that. All the others are not as good, and they did not have the ability to eliminate a crash, okay? This little mini crash in 2020, if it had gone through there without a bobble and come out around here, we would probably have it included in the portfolio. But none of these other ones eliminated any risk, and they didn't make as much money. That's why the investment resolves into one main product. In this particular case, OIEJX, 100% of your money. With my own timer that I use, I do pretty good. The yellow is buy and hold the S&P 500. right, which is superior to everything in this particular 401k, but they'll be very close to this. And the goal here is to see, is there a simple way we could time this if we had to and beat the S&P 500? So my timer that I use now, we're up basically 13% a year instead of 7% a year. And the maximum drawdown we had was only 9% compared to a 56% drawdown suffered by the S&P 500. There is no timer better than this. I can just guarantee you. So what are we going to do in case that's not available? You can go to stockcharts.com, and then you do your search. You find this thing called, it's a $SPXA 200R. That means it's the S&P 500, the percent of stocks that are above their 200-day moving average. And you can actually just go click on that little picture of a chart and it'll pop right up. Okay, here's what the default would show up. And so we have to make a few changes to turn this into a useful timer. First thing we do, if you look down below the chart in overlays, they have two simple moving averages. They have a 50-day and a 200-day. Change the 50-day to 9 days. Get rid of the 200-day moving average. The indicators, if you click on them and roll it all the way to the top, you can find the choice none. You get rid of those. You don't need to look at those. When you've done that, click the update or else nothing will happen. All right. So we click the update and we get this chart. I've expanded it to 5 years. Actually, this is a little less than 5 years. Take a look at it. We make the main data invisible. All right. We're only interested in the smooth average for our signals. If we allow the main data to show up, it's confusing and not needed. This is only a 9-day smooth on that data. So it's going to hang in there very close to the daily data, but it's a lot smoother and won't give you so many start and stop signals. Also, you can expand the chart. If you click on here, expand it to the 900 and it'll give you a bigger chart. Turn off the log scale. All right. We're looking at percent now. We want to be able to see very accurately when we're around where our signals are going to be. You might have to even change the browser. So you look at maybe 90%, 100%, 110%, 120. At one of those percentages, you might find that these numbers are way more visible. Just depends on your own monitor and everything. Sometimes these are hard to read, so you can play around with that and find what you need so you can read this chart very accurately. So now we've blown the chart up. You can either copy and paste this picture into Excel if you want to add your lines, or there's a way to actually go in there and add back these lines. It's just horizontal lines, and you type in a certain percentage. We'll do 62 for the top line and a 7 down here for the bottom line. And those will show up in the online chart. So you can do all your trading right there on the online chart. Now, I don't think you can save it this way for free. I know that if you pay, you can save exactly this and save you some time. But once you get used to it, this is about 2 minutes to change. And most likely you're only going to do this on the weekend anyway. If I'm not around to send out signals, you don't have to do this every day if you don't have time. And so you have to go back and read this over again, or else watch the YouTube and step through it so that you end up with your 9-day moving average of the S&P 500 percent of 200-day stocks above their 200-day moving average. We're looking at the crash in 2020 and then recently what it's been doing. Here's that 62% line we added, and there's the line at 7% we added. So how do we use these? So I'll put a red star over each time we were generating a sell everything signal, all right? So you're in the market, it starts to fall. When do you go cash? Well, you go cash when that line crosses from above to below the 62% line. Let's take a look at that. It happened here, so I put a little red star. Now it also happened right down here, but you already would have been cash if you'd have paid attention and looked at the chart. If you didn't get out here, that's the wrong time. But, you need to be going back in time and seeing, okay, yeah, I'm not in the market right here. It came up just above our line and went right back down again. So yes, there's another sell everything signal. Sell everything here and sell again just a few months ago. Now I had a green circle when we got back into the market. So you see the big crash. It went below that 7% line. And so when it came back up, that was our signal to go back in the market. And that's the very best time to get back in the market. It's pretty safe. Went up, messed around. It crossed this line and gave another buy signal. Of course, you don't need that extra buy signal. You're already in the market from down here. Then it dipped down below, and so there's a sell. But then it came right back up, and so there's a buy. Nothing happened again until you had a sell, another buy, a month later a sell. And now we're back on our way up, so that the S&P, as far as this signal is concerned, for what you could do for free, it hasn't signaled buy yet again. All right, next lines we're going to talk about are dummy lines. This didn't happen, but if it had have happened, why we may need to use our brain to override the signal. Let's say we got back in the market after it had made this crash back in 2020, but the actual market went like this. It started coming down. We can kind of make a mental note that when it gets below the last time it was this high, that's probably pretty bad. We go cash. Even though it didn't go up and signal a crash, we still would like to get out now instead of waiting till down here if it looks like particularly if there's news that makes it look like we're in for trouble for a long time. So there's where we could override and not just blindly wait for it to get all the way down here. If we see that it's below some points that have already produced an interesting resistance line. By the same token, here was a sell. Yeah, one false. Oh boy, turn back around. Now we're above it. So it's a little bit of a risk. And if you do this, you have to say, okay, if it goes back down below this point, I'm going to sell. All right. I overrode the signal and I went back in the market right here because it looked like we were getting above the last time we had some trouble. But if in the next week it dropped back below this line, I would sell again. All you're doing is pretending that your signal line is down here. And so you don't want to ride that signal all the way to the bottom and say, well, I just guessed wrong. You don't have to guess wrong. You simply mentally put a different trigger line based on, I think it's good enough to go back in the market. Well, then where do you put the line that says it's time to get out of the market? Same place. So if it goes below that little fake peak there, you would get out. So I hope you don't have to do that. I hope I'm around for the next 20 years, but odds are that ain't going to happen. But there's no reason that you can't use this for free signal system that I set up. This is back tested all the way back to 2006, and it's the finest signal you can get for free without fancy software. How good is it? We didn't get a 13% a year return, but we were able to get over 9% a year return. And we clearly get rid of the 56% drawdowns that we had by buy and hold, and we've knocked that down to just 12.5% drawdowns. So this signal that I've got you for free is still better than 99.9% of all the advisors that try to time the market, because they don't have a formula that's this good. That's just the way it is. It's hard to come up with a really good formula that'll back test, all the way back to 1993 or something like that. And that's what this thing does. And luckily, you can find the data for free on stock charts if you have to do it on stock charts.